is UnitedHealth Group right now a falling knife, a value trap, or maybe, just maybe, the ultimate undervalued buy? I mean, really think about that for a second.
It's a massive question.
Right. Because, look, it is April 21st, 2026. The stock is hovering right near $323.48, and the entire market is basically just holding its collective breath.
Yeah, because their Q1 earnings dropped today.
Exactly. Earnings dropped today.
And, the tension across the trading desks right now is just palpable, especially when you consider the historic volatility we saw in this name throughout all of 2025.
Which is exactly why we are unpacking this today. So our mission for this deep dive is to really help you, the listener, sift through the absolute noise of UnitedHealth Group's chaotic past year. We're going to break down the balance sheets, translate the technical signals, and really just debate whether the bulls or the bears have the upper hand here.
It's going to be a heavy one.
Oh, for sure. And just a quick critical housekeeping reminder before we start tearing into the data. Make sure you like the video, subscribe to our YouTube channel, and honestly, it is compulsory to leave us a comment with your feedback.
Yeah.
We want to know what you think of this stock. Also, what we are doing here today is just natural human debate.
Right.
We are exploring the arguments and the numbers for informational purposes only. This is absolutely not financial advice. We are not telling you what to do with your money.
Yeah, we are just mapping out the terrain. You have to decide how you want to navigate it yourself.
Exactly. So let's look at the actual terrain, starting with the raw financial numbers from the 2025 full year. Because this is really what drove the stock to bounce between a 52-week low of $234.60.
Which was a brutal low.
Brutal, all the way up to a high of $453.50. So on the top line, the revenue is just staggering. I mean, they brought in $447.6 billion.
Million, with a B.
With a B. That is a 12% increase year over year. But the bottom line tells a completely different, much darker story. Earnings from operations just plummeted, down by 40.5% to $19 billion, or $21.7 billion adjusted.
Wow.
And their net income margin was basically cut in half, dropping from 5.2% down to just 2.7%.
What's really fascinating here is you don't often see those two metrics, revenue and profit margin, moving in completely opposite directions in the scale.
Right.
Like when a company brings in nearly $500 billion, but only keeps 2.7% of it as net income, it forces us to, look under the hood at the operational costs. And the main culprit our sources point to is the medical care ratio, or MCR.
Yeah, the MCR. So the sources show the MCR jumped 340 basis points, which basically translates to a 3.4% increase, landing at 89.1%. And let's translate that mechanism for the listener really quick. The MCR is basically the percentage of premium dollars that an insurance company actually pays out for clinical services.
Exactly. It's the cost of care.
Right. So an 89.1% MCR means that for every dollar UnitedHealth takes in from premiums, they're paying out roughly 89 cents to cover hospital stays, surgeries, doctor visits, all that. That leaves them with just about 11 cents to cover all their internal administrative costs, marketing, tech infrastructure, and whatever is left over after all is profit.
And shrinking that leftover pie by 3.4% is massive when you are dealing with hundreds of billions of dollars.
Right. Okay, let's unpack this with an analogy.
Okay.
It sounds like a wildly popular restaurant that is doing, record-breaking sales, right?
Yeah.
The line is out the door, but their profit margins are shrinking because the cost of their ingredients suddenly skyrocketed.
That's a perfect way to look at it.
But I got to ask, is an 89.1% medical care ratio a temporary blip, like a bad quarter for ingredient costs, or is this a structural leak in their entire business model?
Well, to understand why this is happening, we have to look at the underlying behavioral shifts. So in 2025, the industry saw a drastic spike in medical utilization.
Oh, right. The post-pandemic backlog.
Exactly. Post-pandemic, we have an aging population that suddenly started booking all those elective surgeries. Knee replacements, hip replacements, cataract surgeries, things they had put off for literally years.
Yeah, they finally felt safe going back to the hospitals.
Right. And that elevated utilization directly squeezes the margins because UnitedHealth is suddenly cutting way more checks to hospitals than their actuarial models predicted when they, originally set the premium prices.
But I have to push back a little on the idea that it was just seniors getting hip replacements, though, because the sources also specifically highlight the 2025 cyber attacks that hit the healthcare sector.
Oh, absolutely.
And that wasn't just like a data breach where some passwords got stolen. That was a massive systemic freeze of the Change Healthcare network, which, by the way, UnitedHealth owns.
Yeah, that is a critical piece of the puzzle. I mean, the Change Healthcare network processes roughly one-third of all patient records in the U.S.
That's insane. One-third.
It's massive. So when that system went down, it essentially severed the financial arteries of the entire healthcare system. Hospitals and clinics literally couldn't bill for their services. So to prevent the whole system from just collapsing, UnitedHealth had to step in.
Right, they had to act like a bank.
Exactly. They provided billions of dollars in advance funding and interest-free loans to these providers just to keep the lights on.
So they are essentially floating the entire medical industry with their own cash, while simultaneously dealing with a spike in patient claims, all while paying the massive IT and recovery costs to, rebuild their infrastructure.
Yep.
I mean, that perfectly explains why the net income evaporated. But the thing is, they aren't broke. The data shows they generated a very strong operating cash flow of $24.2 billion.
Which is a huge safety net.
Yeah. And their balance sheet is stable. They've got $28.1 billion in cash against $83 billion in debt, which puts their debt-to-capital ratio at a pretty manageable 43.9%.
Right, so they have the liquidity to absorb the shock. I mean, a company generating over $24 billion in operating cash flow is structurally sound. But here's the thing. For the stock market, mere survival isn't enough. Institutional investors are looking at a fundamentally altered profit profile, which creates this deep disconnect between the company's sheer size and its current stock performance.
So let's look at how that disconnect is actually trading on the market today. Because if we pull up the technical charts, the price action is incredibly conflicted.
It's a mess, technically speaking.
It really is. Year to date, the stock is down about 2.801%, which is technically neutral to bearish. But over the last month alone, we've seen a massive 18.80% bullish burst, like out of nowhere.
Yeah, a huge rally.
And the price has actually crossed above both the 20-day and 50-day simple moving averages. Plus, the momentum indicators are just screaming that buyers are stepping in. The RSI is sitting at 68.29, and the MACD is at 7.63.
We should probably unpack what those indicators are actually measuring for the listener because they tell us a lot about current market psychology. So the RSI, or Relative Strength Index, it measures the speed and magnitude of recent price changes on a scale of 0 to 100.
Right.
At 68.29, it is showing very strong upward momentum, but it is knocking on the door of the 70 level. And historically, anything over 70 is considered overbought, meaning the buying pressure might be exhausting itself, and a pullback is, highly likely.
And then you have the MCD, the moving average divergence, which is basically comparing a short-term moving average of the stock's price to a longer-term moving average.
Exactly.
So when the MACD is positive at 7.63, it means the short-term trend is rising way faster than the long-term trend. It's a classic signal that momentum is accelerating.
Right. It looks great on the surface.
But here's the catch that the sources highlight, and here's where it gets really interesting. Despite this short-term sprint, the stock is still trapped in a medium-term falling channel with a technical rating of just 5 out of 10.
Yeah, the longer trend is still down.
Right. It reminds me of a runner sprinting uphill on a treadmill. Like they are moving their legs incredibly fast. That's the RSI and MACD going up. But the treadmill itself is pulling them backward, which is that long-term falling channel from the 2024 peaks.
That's a great visual. And that treadmill effect becomes really dangerous when the price hits a critical resistance level, which is actually happening right now.
Exactly. So what happens when that speeding car hits the brick wall of resistance?
Well, the stock is testing heavy resistance right in the $323 to $325 zone. And the primary sell zones actually start around $300. You have to understand the psychology here. Resistance zones represent a psychological barrier. Imagine a retail trader who bought UnitedHealth at, say, $350 right before the 2025 cyber attack. They watched their investment tank all the way down to the 230s. They spend a whole year completely in the red.
Staring at losses every day.
Right. So the moment the stock rallies back up to 325, they sell just to cut their losses and get their original money back.
It's the thank God I'm breaking even trade.
Exactly. It creates a literal wall of supply. You have those break-even sellers combined with institutional algorithms that are programmed to short the stock at previous areas of supply. And retail traders often see that green RSI and mistake short-term momentum for a permanent trend reversal. So they start buying right at the exact level where the larger players are unloading.
Wow. And if it gets rejected at 325, the floor is a long, long way down.
Yeah.
I mean, the structural support, the 2025 washout bottom we talked about, sits way down between $210 and
It's
$239.
a massive drop.
Yeah, so buying at resistance on earnings day with a potential $100 air pocket underneath
Yeah.
is just the definition of high risk.
Right.
But, the charts really only tell us what the broader crowd is doing.
Right.
To really figure out if that risk is worth taking, we need to look at what the ultimate insiders and Wall Street analysts are doing. What are the executives doing with their own money?
Well, insider buying is usually a signal of profound confidence. I mean, executives receive stock options all the time as compensation, but when they use their own open market cash to buy shares, it signals they genuinely believe the market has fundamentally mispriced the business.
And we saw an undeniable signal of that in May of 2025. There was this massive cluster buying right around the $290 level. The CEO dropped $25 million of his own cash.
Only 25 million.
Yeah, the CFO added another $5 million. I mean, when a CEO drops $25 million of their own cash, that's not just a polite vote of confidence. That's a megaphone to the market.
It really is.
But I got to play devil's advocate here because the sources also show that Director Charles Baker sold $3.4 million worth of stock in September 2025, right at the $463.74 peak.
Which highlights the duality of the situation. Insiders are happy to accumulate under $300, but they are equally willing to take profits near the all-time highs. But currently, at $323, we are seeing notable whale accumulation.
And the big institutional funds.
Exactly, large funds quietly building positions. And Wall Street analysts are largely aligned with this optimism. I mean, they hold a 79% buy or strong buy consensus. They've placed an average price target of $364.79 with a high of $440 and a low of $278.
But those analyst targets bring us to a bizarre valuation paradox. Right now, UnitedHealth price to earnings ratio, the PE, sits at 24.52.
Yep.
Now, if you compare that to the broader healthcare industry average, which is around 21.0, UnitedHealth is expensive. You're paying a premium compared to its peers. However, if you compare it to UnitedHealth's own historical fair PE, which is roughly 37, it looks like an absolute bargain. But I have to challenge this 37x multiple. Like, why should a health insurance company ever trade at a multiple that high? That's the kind of valuation you usually see in high-growth tech stocks, not an established healthcare payer facing rising medical costs. Reconcile that for me.
Okay, if we connect this to the bigger picture, the market historically granted them that premium because UnitedHealth is not just an insurance payer.
Sure.
They are vertically integrated. Through their Optum division, they own primary care practices, surgical centers, pharmacy benefit managers, and massive data analytics platforms. They essentially control every single link in the healthcare supply chain.
Which is an incredible advantage.
Exactly. That vertical integration traditionally provided a moat that insulated them from the very margin pressures we are seeing now.
Oh, I see. Which means the current PE of 24 is basically the market saying your moat is currently flooded. Like, institutional investors are just refusing to pay that 37x premium until UnitedHealth actually prove they can plug the hole in their margins and control the chaos of 2025.
Precisely. And that brings us to the core debate for you, the listener. Is this a temporary discount on a dominant monopoly, making it a heavily undervalued opportunity? Or is it a value trap?
Okay, let's lay out the bull case first, the recovery scenario. The bulls are looking directly at that vertical integration you just mentioned. They see a company with a 16-year streak of consecutive dividend growth.
Which is nothing to sneeze at.
Not at all. And they are looking at long-term discounted cash flow models, which, estimate the present value of the company based on all its future cash flows. And those models suggest a fair value of $530 or more.
Wow.
So the bullish argument is essentially, ignore the short-term noise, the scale advantage will eventually win out, and you get paid a growing dividend while you wait for it to return to $530.
But the bear case focuses on a structural incoming threat that could severely suppress those future cash flows. Specifically, the Centers for Medicare and Medicaid Services, CMS, is aggressively tightening the rates they pay out for Medicare Advantage plans.
So this is the big one.
Yeah. Our sources point to a looming $6 billion Medicare funding headwind.
We really need to unpack how Medicare Advantage actually works so the listener understands why a $6 billion hit is so dangerous. So, in a standard Medicare Advantage plan, the government pays UnitedHealth a fixed monthly fee to manage a senior's health care.
Right.
If that senior stays relatively healthy, UnitedHealth's cost of care is low, and they keep the rest of that monthly fee as profit.
But if that senior requires a hip replacement, a week in the hospital, and ongoing physical therapy, the cost of care skyrockets. But UnitedHealth still only gets that same flat fee from the government?
Meaning they have to eat the loss.
Exactly.
So here's the double squeeze. We already established earlier that seniors are utilizing more care. They're booking those deferred surgeries, so the costs are going up. Now, CMS is essentially saying, we are also going to cut the flat fee we pay you.
Yeah, so costs go up, revenue per patient goes down.
That is a recipe for severe, sustained margin compression. And that leads us to the whole concept of the value trap. Sometimes a stock looks like a heavily discounted designer jacket, but then you try it on and realize the lining is completely ripped out.
That's exactly what a value trap is.
Right. I mean, scale is great, but can a 16-year dividend streak really protect investors from a $6 billion Medicare funding hit? It's like buying a massive luxury house on the coast at a 50% discount. It looks incredibly cheap on paper. But what you don't realize is that the cliff the house is built on is actively eroding into the ocean.
Right. The price is cheap, but the underlying foundation is deteriorating faster than the discount accounts for. So the risk for retail traders today is buying in at $325 because it seems cheap compared to those $450 highs, without realizing the market is going to spend the next 4 quarters slowly pricing in that $6 billion Medicare squeeze.
Yet.
If that foundation continues to erode, the stock will just bleed back down into the 200s.
Wow. Okay, so we've broken down the bull case, the bear case, the technicals, and the shifting fundamentals.
Yeah.
How does all of this collide in the immediate short term, like right now?
It collides today, April 21st, 2026. As we said, the Q1 earnings call is going to dictate the immediate direction. The specific hurdle they have to clear is the earnings per share estimate, which is pegged between $6.48 and $6.62.
Okay.
If they miss that EPS target, or if their forward guidance admits that the Medicare Advantage cuts are going to hurt worse than expected, that 325 resistance zone we talked about will act like a titanium ceiling, and the bears will take complete control.
But if they beat the estimate, if they can show that the cyber attack costs are fully behind them and that their Optum division is offsetting the Medicare pressure, the long-term outlook is actually incredibly favorable.
Absolutely.
Because they have set 2026 targets of $17.75 in EPS and over $439 billion in revenue. If they hit those numbers, they return to their historical 13 to 16% growth trajectory.
And that 37x PE multiple might just come back into play. Ultimately, the market needs proof that 2025 was just a historical anomaly, not the new operational baseline.
So what does this all mean for you? You are watching the absolute titan of the healthcare industry at a critical crossroads. Will it break through the technical resistance and validate the CEO's $25 million bet? Or will it succumb to the Medicare headwinds, proving the value trap theory right?
It's the ultimate showdown.
It really is. So do your own research, weigh the mechanics we've discussed today, and decide where your risk tolerance lies. Because again, this is not financial advice.
And I want to leave you with one final thought to mull over today. We've spent this entire time analyzing UnitedHealth's vulnerability. But if a vertically integrated $447 billion giant with a near monopoly on health data can have its profit margins completely dismantled by a single cyber attack and a shift in Medicare rates, what does that mean for the vulnerability of the entire healthcare sector? I mean, the smaller regional insurers and care providers who don't have $24 billion in operating cash flow to fall back on. If UnitedHealth misses their earnings target today, it might not just be a warning sign for one stock. It could be a massive red flag for the entire healthcare ecosystem.
Man, that reframes the entire earnings call. It's not just a referendum on one company. It's a stress test for the entire industry.
Exactly.
Well, thank you for joining us to unpack the noise, and we will see you on the next deep dive.